Gas prices just jumped nearly $1 per gallon in a week. Oil briefly surged to around $119 per barrel, the highest level since 2022. Markets reacted immediately. The Dow dropped hundreds of points, and investors rushed into energy stocks. But if you look at the last 50 years of oil crises, the one pattern is shockingly consistent. Oil spikes, investors panic, and then the trade completely reverses. So in this video, we're going to look at actual historical data from the past 5 oil shocks and what typically happens to markets after them. Right now, the biggest risk to global oil supply is the Strait of Hormuz. About 20% of the world's oil supply passes through this narrow shipping route, making it one of the most important choke points in global energy markets. Recent geopolitical tensions have dramatically reduced tanker traffic through the region, pushing oil prices toward $119 per barrel before stabilizing. The International Energy Agency estimates that disruptions in the region could temporarily remove up to 8 to 10 million barrels per day from global supply, which would be one of the largest supply shocks ever recorded. So yes, the fear in markets right now is real. 1973. OPEC oil embargo. Oil prices exploded from roughly $3 per barrel in 1973 to around $12 by 1974, a 4-fold increase. Markets panicked. But within years, prices stabilized and eventually collapsed in the 1980s. 1979. Iranian Revolution. The Iranian Revolution removed millions of barrels from global supply. Oil prices surged to about $35 per barrel by 1980, nearly tripling in just a few years. By the mid-1980s, however, oil prices crashed to nearly $12 per barrel. 1990. Iraq invades Kuwait. When Saddam Hussein invaded Kuwait, oil prices briefly doubled. Average prices jumped from roughly $17 per barrel in 1989 to over $33 during the spike. But once supply normalized, oil quickly fell again. 2008. Commodity bubble. Oil reached its all-time peak near $147 per barrel in July 2008. But during the financial crisis, oil collapsed to around $40 within months, one of the fastest commodity crashes ever recorded. 2022. Russia invades Ukraine. When Russia invaded Ukraine, oil surged above $120 to $130 per barrel. Within months, prices dropped nearly 30% as markets stabilized. In 1979, the Iranian crisis removed about 7% of global oil supply. Today, disruptions around the Strait of Hormuz could potentially affect up to 20% of global supply. Back in 1979, oil represented about 1.5% of the U.S. economy. Today, it's closer to 0.4% of GDP. That means the economy is roughly 70% less dependent on oil than it was 45 years ago. Several things changed. Cars became far more fuel efficient. Homes shifted from oil heating to natural gas and electricity. Renewables have expanded, and remote work reduced commuting. So even if oil spikes above $100 per barrel, the economic damage today is far smaller than it would have been decades ago. However, there is one important exception: diesel fuel. Diesel powers global logistics, trucks, cargo ships, trains, and heavy equipment. When diesel prices spike, shipping costs rise, and those costs ripple through the entire economy. That's why energy shocks can still impact inflation. But historically, markets tend to recover quickly after geopolitical shocks. According to historical market studies, the average stock market drop during geopolitical shocks is about 4 to 5%. Markets typically bottom within about 3 weeks, and historically, the market is higher 1 year later, about 70% of the time. The biggest mistake investors make during these periods is chasing the spike, buying energy at the top and selling everything else. Take 2022. When Russia invaded Ukraine, oil surged to $130 per barrel. At the same time, the Nasdaq dropped 33%. Investors were dumping tech stocks and rushing into energy. But 4 months later, oil was back below $100, and tech stocks began recovering. If you bought the Nasdaq 100 ETF at the bottom, it eventually rallied more than 50%. That's an almost 90% swing from panic to recovery. The historical pattern is remarkably consistent. Oil spikes, investors panic, money rushes into energy, and then oil prices reverse. Now, that doesn't mean this outcome is guaranteed. If the disruption in the Strait of Hormuz lasts months, the situation could change dramatically. Thanks for watching. If you enjoy data-driven breakdowns of global markets, consider subscribing to the channel.